Good afternoon, everybody. JD here with your Rational Trader Market Analysis Daily. In today's video, I want to spend some time on the arbitrage opportunity between the volatility index and the fade volatility short ETF, the SVXY. Now, today, the volatility index once again traded below 17 on its way to my eventual target, which is below 15. And perhaps by late July, we get down into the 13, 14 range as the market really calms itself after the tariff tsunami of earlier this spring. Now, with the volatility index below 17, I found it really informative to look at the last time we were below 17 on the volatility index at the end of March. You can see here, let's see, we were on March 24th, I believe, uh, March 25th, yeah, right at 17 on March 25. So very close to where the volatility index is today. So remember that date, March 25. Then again, in late February, when tariffs were first announced, and we got that first mini spike in volatility, the volatility index on February 20th was at 16 and a half. Again, very close to where we're at today. Now, this isn't exact science here, but it's a pattern that I think is very, very informative to what's going on in the market. And it also identifies, in my humble opinion, an opportunity for traders to make money with a high degree of confidence. Specifically on the short side of volatility, the SVXY, if we look at where that SVXY traded on, well, now I can't pull it up here, of course. Let's see, try that again. There we go. And zoom out 6 months, and you can see on March 25th, let's go to March 25 when the volatility index was uh, right at 17. Okay. The SVXY at that time was, as you can see, 40, almost $49 a share. And where did we close today? Look at that, $41. So we're at the basically the same level for the volatility index, and yet there's this disparity in pricing on the SVXY relative to the underlying volatility index. Now, there's a perfectly good reason for that. Basically, the large institutional traders, the hedge funds, are very, very skeptical and do not want to get caught with a position in the market that isn't hedged for a not a volatility decline, but a volatility spike. And it's just fascinating it's almost like the market is forcing them to calm down. It's almost like forced medication. They don't want to own the SVXY, but they're going to own the SVXY. They almost have no choice. But you can see on March 25th, you know, that's what, $7 of discrepancy in price. If we go to February 20th, the other date where we were trading at a similar level, the volatility SVXY was above 50 at 52, right? So you can see, we've got, to me, more and more confidence that that gap in pricing between the volatility index is going to stay the same, and this wide gap between the SVXY at previous moments in time when the volatility index was exactly at the same spot, that gap is going to narrow. Okay. And traders aren't going to like it. They're going to believe that the gap's going to narrow because volatility is going to come back up. But if you think about it, the case for that argument uh, doesn't necessarily hold water. And in fact, the evidence that I'm looking at suggests that there's going to be a volatility decline. Now, uh, I'm on record in November and December pounding the table for being positioned for volatility spikes. Now, at that time, the volatility index was even lower than it is today. You can go back a year here on the volatility index, and you can see last summer we were above $63 a share. So as this gap closes, the hedge funds will tell you that, well, the gap's going to close because volatility is going to go up. I I'm not convinced of that. Certainly there's a possibility, but it's a small possibility. In my opinion, the higher probability, 95% degree confidence, same degree of confidence I had back in November and December when I said that volatility was going to spike multiple times. You have much more certainty on the economy and on policy today than you did back in the immediate aftermath of Trump version 2.0. So I just think this is a ring the bell, slam dunk money making opportunity to own the SVXY. Forget about trading it. Now I'm trading it intraday. That's, I can make money doing that. But just if you're looking for a no-brainer money-making opportunity, buying the SVXY here at just around $42 a share and riding it to my target, which is a minimum of 50 or 55 for that matter, and then possibly back up to 60 by the end of this summer, that's $20 of value, aka 50%, right, on a $40 stock price. So that is really being handed to you on a silver platter right now. So I'm just I couldn't be more enthusiastic about that trade, and I think you'll be really happy. Now, here's something really fascinating, okay? As this gap in arbitrage corrects, one thing that I'm going to be doing is that when we get up to 55 on the SVXY, okay, that's going to be my signal to position for, guess, the flip side. That's when I go long volatility, because we're going to be back in that complacency point where the VIX is below 15, maybe even down to 13, 14, especially if we get up to 60. Man, we get up to 60 on the SVXY. It is, ding, 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 ring that bell going into the VIXY. And you got an opportunity to make 50% here. You got an opportunity to make 50% when we get. So the narrative here to me is plain as day. So there you go. That's the best I've got for you, and it really doesn't get any better than this arbitrage in volatility. This is JD for The Rational Trader. That's all I've got for today. I'll be back tomorrow with another video. Take care. Have a great day, and we'll see you all next time.